Good afternoon to everybody. Good morning to our speakers. So we start our next session, and the topic of the next session is monetary policy modification in advanced economies and the effect on emerging market economies. So it's not a secret for everybody that the United States has recently gone through monetary policy review and came up with the new monetary policy framework. Europe is going through the same process right now. Other countries like Canada go through them regularly. And of course, this new emerging monetary policy frameworks is still to some extent are enigmas for market participants, for central banks from emerging market countries. So for us, for the Bank of Russia, for our market, and for our monetary policy review as well, it would be very interesting to figure out the more details about the American new framework and maybe a line of thinking of other countries and how it can affect our economy, our financial markets, and our policy. And we have a very good panel today, a distinguished panel to discuss this issue. So let me introduce the panelists. I will start with Bill Dudley. Bill Dudley, for about 10 years, was the president of the Federal Reserve Bank of New York. Then the next one is Steve Cighetti. Steve actually also worked at the Federal Reserve Bank of New York for some time ago, but now he is a professor at the Brandeis University, and he is also the vice chair of the Advisory Scientific Committee of the European Systemic Risk Board. Then we have Blaise Anting. Blaise, he will speak from the financial markets because he's the head of sovereign research team at the asset management firm TCW Group. And this is a group which has $250 billion under its management. And well, the last but not the least is Oleg Otshoky. Oleg is a graduate of Moscow State University of the New Economics School. He, for a number of years, was a professor at Princeton. Now he is a professor of economics at UCLA. And he's a specialist on international economics, on international financial markets, on exchange rates, etc. So I think that he would give us some theoretical perspective on some of the aspects of the issue. Okay, so let me start the discussion. But before we will move to the main topic of our discussion, the details of the new framework, particularly Fed framework, I would like to ask Steve a more basic question. Well, we all know that the Fed has double mandate. And particularly here in Russia, there are a lot of interpretation that because it is a double mandate, it's something very different from inflation targeting of the type of Bank of Russia and some other economies. So could you please give your view whether there is a really fundamental difference between the Fed framework and, say, inflation targeting framework like the Bank of Russia has, or the difference is much smaller than it seems. And at the end of the day, all of those frameworks are aimed at keeping inflation stable, well, low, but not that low. Thank you very much, Steve. The floor is yours.
Thank you, Ksenia, and thank you for this lovely invitation. And hopefully next year we'll be able to meet again in St. Petersburg. So first of all, the vast majority of central banks in the world, I think more than 3/4 of GDP of the world, probably significantly more than that now, are inflation targeting, and I would put the Federal Reserve certainly in that category. The U.S. monetary policymakers state their longer-term goals. Longer-term goal at inflation of 2%. They choose a particular index. Everyone has to do that. There have been some changes in the framework recently, but these are not fundamental changes. You mentioned we'll get to those later, so I'll save my comments, and Bill will probably have a lot more to say about that. But I think what's important to keep in mind is that it is true that Fed policymakers always refer to their dual mandate. That's what's in their legislation. They do state it with some frequency as a goal of achieving maximum sustainable employment through price stability. And the rationale for price stability as what is the goal through which you then obtain maximum employment and improve the welfare of your citizens is pretty much the same, I think, everywhere in the world. And that is, first of all, that low inflation tends to be more stable, so there's less short-term uncertainty associated with low inflation. And so that's good for growth and employment. And second, I think that the Bank of Russia states their expectation for the benefits of price stability, which are common around the world and are shared by central banks, including the Federal Reserve, when they state that when inflation stays low and predictable, households tend to save money in the national currency for long periods without worrying, and that they're confident that their deposits will not decrease in value due to inflation. So overall, I really don't see, while it is the case that there's a dual mandate in the legislation of the Federal Reserve Act, and while other central banks often will have statements of other goals, sometimes equal, sometimes secondary to price stability, that price stability is the objective through which you achieve all these other goals. And without price stability, you really don't get anything.
Well, thank you very much, Steve. Let us also discuss another fundamental question before we move to a more practical one, and I would like to address this question to Oleg. So I think the reason is saying that when America get a cold, everybody else get a fever or something like this, right? So why U.S. monetary policy, or in more generally advanced countries' monetary policy, is so important for emerging markets? So let's just let me ask this, and then I'll probably ask an additional question.
Quickly, before I get into it, a quick remark on the previous question, which is actually a nice segue. So in the last over 30 years, close to 40 years now, the US has been in a low inflation environment. And so as a result, there is very little sort of trade-off posed between like stabilizing prices and other goals, because prices have been stable, right? And so the question, like, you could really check whether it's true inflation targeting or not when there is a real trade-off between the two. And so the current episode is actually quite interesting because there is inflationary pressure now in the United States. And actually there is little doubt that before we see inflation, we'll just see higher rates. And so the Federal Reserve, with quite a high likelihood, can raise the interest rates in the foreseeable future before we see any inflation. So there is pretty big confidence that that's what's going to happen. If anything, we'll see higher interest rates, but probably not higher inflation. And so here's the segue, right? What will happen when the United States plausibly raises interest rates in the foreseeable future? And so that's exactly what can cause problems for the rest of the world, because an increase in interest rates in the United States will lead to an appreciation of the dollar. So, while a lot of people in different countries wait depreciation of the dollar, actually the current period will likely see with some probability a stronger dollar over foreseeable future. And a stronger dollar typically is a problem for a lot of other countries. And there are two channels, and they work in the same direction. So the first channel is via the financial market. So higher interest rates in the United States and stronger US dollar, they actually have a strong negative effect on the balance sheet of the financial sector, which tends to operate in dollars. And so a lot of the liabilities on the balance sheets of the financial system are actually in dollars, while the assets are in the mix of currencies. And so as a result, an appreciation of the dollar really affects the balance sheets of the financial sector, in particular in many developing countries. And so this poses a challenge for a lot of the central banks, because it could be that the business cycle lags behind the American business cycle, in the sense that the recovery is going faster in the US than in parts of the world. And so it would be too early to raise the interest rates in the rest of the world. but stronger dollar will put pressure on the balance sheet of the financial sector, and that would require kind of like coordinating the monetary policy with the American rates, and that would basically create an unpleasant trade-off between sort of slowing down the economy or negatively affecting the financial sector. So what's important to point out here is the sovereign borrowing, the borrowing by the countries and governments, is less and less in dollars now. But the borrowing by financial sector is actually increasingly in dollars, and sort of the financial sector is much more globalized now, and the role of the dollar has only increased over the last 20, 30 years in this area. Well, just to briefly mention, there is a second channel of spillovers that goes through the goods market. A large chunk of international trade is denominated in dollars, and what's important is done in trade between countries that do not directly trade with the United States. So, for example, a lot of trade between Japan and Australia, for example, would be in dollars. Between many Asian countries and European countries is in dollars. And whenever dollar appreciates, it's sort of like a tax on international trade, because traded goods are becoming instantaneously higher, right? So trade's becoming more expensive, and this is sort of like another way to slow down the global economy. And so that would pose another challenge, is that the other countries will need to somehow kind of keep up with the dollar appreciation through now the goods market channel. And so that's, again, will pose a similar type of trade-off.
Okay, thank you very much, Oleg. You raised this issue of spillovers, and I'll probably later on ask some specific question about that. So now let me move to Bill. Bill, first of all, what is this new framework? What is this average inflation targeting with this changed sort of mandate on employment and so on? What is it? How it works? Right. This is my first question, and I will ask you right away the next question. Well, this, as Oleg said, inflation was very low in the US for the last many years, well, at least 10, 20 years. And this framework was invented to address the specific of this situation with very low inflation and zero low bound. And now it looks like we are in a different world. Right, we can get into long discussion whether we see temporary increase of inflation or not so temporary, but well, even in the US, inflation is like 4 or 5%, and I guess it was not what it was expected to sort of happen that quickly when the framework was invented. So is it suitable for this new environment, or there may be some risks due to the fact that the framework was invented for a somewhat different pre-COVID environment? Thank you.
So thank you for having me today. The Fed changed their monetary policy framework from trying to hit 2% inflation always to trying to hit 2% inflation on average. And the reason they made that change is what you alluded to. They were missing inflation persistently to the downside of their 2% objective. And because they were missing persistently to the downside, that was causing inflation expectations to start to get saggy and soft, and that was increasing the risk of the Fed having less monetary policy ammunition to respond to recessions. The U.S. was essentially at risk of falling into a Japanese-style outcome. So the Fed basically said, look, we're going to change our monetary policy framework. We're not going to target 2% inflation every period. We're going to target 2% inflation on average. So think of the old regime as, if I miss to the downside, next period I try to hit 2% inflation. If I miss to the downside for 10 years, 100 years, 1,000 years, next period I try to hit 2% inflation. Now the Fed is taking past inflation outcomes into into consideration and considering what to do about inflation now. Now, the goal of this is not really so much to average 2% inflation. The goal of this is to keep inflation expectations well anchored at 2%. You could argue that the policy's already been, pretty successful, because inflation expectations have already drifted up much closer to be consistent with the Fed's 2% objective. So that's what they did. I think it makes good sense. Now the question, I think the critical issue though, is how they actually operationalize this change in policy. What they then said was, this is last September, that we're going to operationalize this policy by saying that we're not going to raise short-term rates until 3 conditions are met. Number 1, we have to be at our view of full employment. Number 2, we have to have reached our 2% inflation objective. And number 3, we have to be confident that inflation is going to rise above 2% for some time to come. Now, why this is so important is it means that the Federal Reserve isn't even going to start raising short-term rates into the economy is probably at or past full employment. This is, how they operationalize the regime is rather extreme. It basically means that the Federal Reserve is going to be pretty late in terms of responding to a tight labor market and higher inflation. What that means for markets is, one, there's going to be a longer period where the Fed keeps interest rates low. Number two, it means that when the Federal Reserve finally starts to tighten monetary policy, they're going to have to do more. They're going to have to do more because inflation will be higher. They're going to have to do more because monetary policy will actually have to be made tight. And the third consequence is that the risk of recession at that point will go up significantly because the Federal Reserve will have to tighten monetary policy sufficiently to probably push the unemployment rate up a bit. And the Fed's success historically in pushing the unemployment rate up a little bit and avoiding recession, they have a very poor track record at doing that. So there's sort of good news and bad news. The Fed has addressed a problem that I think was a significant one, but they've operationalized the policy in a way that does create some risk that the Federal Reserve will be late. And because they'll be late, there'll be more volatility in short-term rates and more risk of recession down the road.
Well, thank you very much, Bill. Steve, do you agree with this description, and do you think that there are indeed these kind of risks?
Yes, absolutely, and I think that that the easiest way to think about the fact that they promised to be late is that they're interpreting their maximum employment part of their mandate not as deviations of employment from its maximum sustainable level, which is what they had, which was in the previous framework, but in terms of shortfalls. And I actually think this does make a lot of sense because they clearly are uncertain about what the maximum sustainable level of employment actually is, but it is a promise, in fact, a commitment, I would say, to be late. And as Bill said, that's likely to lead to more volatility. We of course all hope that it won't, but it is likely to do that. I think that the rationale that Bill explained, I think, is exactly right, which is that the concern is over inflation expectations falling. There's a lot of other discussion about how this might allow them somehow to raise real interest rates by more because of the zero lower bound, but I think that's actually sort of too clever an explanation for what they're doing. I think instead it's really the idea that the best way for them to hit their longer-term inflation goal of 2% is to be clear that they're going to be very symmetrical about how they do this and that they're averaging it over a longer period. But the other thing I would say is that in terms of their operationalizing their new framework, it would be useful if we knew more about the sort of period of time, even roughly, over which they intend to do this averaging. Bill, in his answer to your question, suggested that you could be talking about several years or a decade or something. I just don't know what it is, and so I think it would be useful if they were a tiny bit more specific about that.
Well, thank you very much, Steve. So now let me move to Blaise. Blaise, what does the financial markets think about this? And both Bill and Steve spoke about consequences for American economy, but how all of this will affect emerging markets economies in their markets. So this is one part of the question. And the second part of the question is the following. We all remember taper tantrum of 2013, but a couple of days ago in his interview with the Financial Times, the head of the Reserve Bank of South Africa, Lesetja Kantiago, said that right now he is not so much scared about a taper tantrum, but more about data tantrum. So what is this, and is there really these kind of risks?
Sorry, Ksenia, more about which tantrum? I apologize, I didn't catch what you said.
Data tantrum.
Yeah. Okay. Right. Data. Yes, indeed. I think. First of all, thank you very much for including me in today's discussion. It's flattering to be included in such an impressive group of panelists, and obviously I'm the only non-academic economist on the panel today. So a rather substantial obligation to speak on behalf of all financial markets everywhere. But let me say it first. I think you can see by the behavior of the bond market, in particular the U.S. Treasury market this year, really over the last 6 to 8 months, the sort of push-pull around the messages that the Fed has been sending. And, for sure, we've obviously seen, yields backing up in the U.S. and as a consequence, referring back to the metaphor you used earlier, America has sneezed, the bond market sneezed, and so the rest of the world caught a bit of a cold in the first quarter of this year, and we saw yields backing up in many other countries, both advanced economies as well as in emerging economies. The correlation in the early months of this year was very, very strong. At the same time, though, we've seen this sort of push-pull between the equity markets and the bond market. Typically, there has been, due to the extraordinary period of non-traditional monetary policy, there's been this unusual time where we've had both bond market strength and equity market strength simultaneously. I think as the economies of the world come out of the COVID-induced recession, the question is, how much can that continue? I think many people in the first quarter of this year were of the view that, we had finally reached the end of the road. Treasury yields were going higher significantly, and that we would, not only see the 10-year yield above 1%, we would see it above 2%, and then pushing at some point in 2022 towards 3%. That I think obviously got the attention of the Federal Reserve, which has then spoken more dovishly in the face of data, coming into your question about data. The Fed has, I think, for some people, surprised a bit dovishly with respect to how it interpreted the data and the patience it's been willing to show about the need to remove liquidity from the system and to tighten policy. And so, we've had this correction or partial correction in the Treasury yield back down, the 10-year back down below 1.5%. I think many people assumed by this point of the year we'd already be at 2% on the 10-year. That has created during the second quarter a greater enthusiasm for risk assets. In my space, which is emerging market debt, we've seen significant increase in issuance during the second quarter. Very solid inflows. Very significant market access by sub-investment grade issuers. I think we're in the first half of this year, this has been the single largest year of junk bond issuance. The first 6 months of the year, the largest first half of the year ever for junk bond issuance. Some of it is refinancing, which is good. People taking advantage of the low rates to take out higher coupon debt that they owed. But of course, some of the debt is new, and some of it is being done in dollars, as you said. So, there are risks that are building going forward. But I think that, the Fed seems very anxious to not have another taper tantrum on its hands. I think the South African Reserve Bank is, in its comments, recognizing that the data, we're all sort of data dependent. Everyone is sort of dependent on watching the U.S. data because the Fed is such a big driver of this process right now. And so, yes, just to put some meat on that bone, tomorrow we get the NFP number in the U.S. And I think, we ourselves have delayed some investment decisions this week because we don't know what that data print is going to be. And we don't know what the market response to that data print is going to be. And I think that's something that we're just going to have to get used to here for the coming months and maybe the next several quarters as the Fed responds to data, looks to take liquidity gradually out of the system, and the rest of the world, which has been leveraging up, given the very easy borrowing costs, is going to have to respond to that. So I think central banks in the emerging markets have already started to tighten in many cases. Some of them are still doing QE even as they tighten, which is an interesting approach. Others are, reducing their QE first, but we just see sort of a mixed bag of policy responses. And I think that, markets are going to have to navigate a fairly tricky landscape, at least emerging market investors, as we go through the coming period.
Well, thank you very much, Blaise. We actually have a question from the audience here, which I would like to address to Bill, first of all. Do you see possible spillbacks from emerging markets to the EM? And does Fed framework allows to accounting of all the spillovers and spillbacks and so on?
So, I think there's, obviously people are worried about the risk of another taper tantrum like we had in 2013. I think that originally I thought that risk was pretty high because the Fed was going from a, all-in monetary policy to something different. And when they made that change, that would be quite significant for markets. But I'm less concerned about a taper tantrum now for a couple of reasons. Number one, the Fed has shown tremendous care in terms of how they communicate. They don't want to see a taper tantrum. And number two, market participants have a template this time about how the Fed Reserve is likely to behave. One of the things that I think created the taper tantrum in the first place back in 2013 is people didn't know how the Fed was going to go about normalizing monetary policy. Now we have a pretty clear template. First, you taper the asset purchases, then you raise short-term rates, and then when short-term rates get to a certain level, you start to actually allow the securities portfolio to run off. And so I think people are pretty comfortable now that they understand the Fed's game plan. Does the Fed worry about the spillover effects to emerging market economies? I think the answer is sort of yes and no. Yes, they don't want to disrupt global markets. They don't want to have an undesirable tightening of financial conditions, which is large relative to what they seek in terms of their monetary policy objectives. So certainly they want to communicate clearly. They want people to understand their reaction function. So they want the markets to adjust smoothly to what the Fed does. No, in the sense that at the end of the day, the Fed sets monetary policy for the United States and to achieve the goals of maximum sustainable employment and price stability for the United States. Obviously, everything that happens in the rest of the world, though, is an input to that. So it's not immaterial what happens in the rest of the world in terms of the implications for the U.S. outlook. But the Fed isn't really focused on the consequences of its monetary policy on other countries. It's really focused on the consequences of its monetary policy on its achievement of its U.S. goals.
Okay, thank you very much, Bill. This is great. One more question, maybe to Steve first, but then I'll go back to other participants. Does this new monetary policy framework, or any monetary policy framework, has to take into account the structure of the financial markets? We know it's changed quite significantly in the last 10 to 20 years. Right, and whether changes in the framework should address it. I understand that financial stability framework should address changes in the financial market, but what about monetary policy framework? I guess I'll start with Steve.
Yeah, thanks. First, let me just emphasize something of Bill's point. The financial markets are global, and it certainly is in no one's interest to create financial market turmoil. It's not in that sense the Federal Reserve and all large central banks are concerned with what goes on outside of their borders. And as Oleg pointed out, there's this enormous U.S. dollar system outside of the U.S. It's probably about as big as the U.S. banking system. There are about $20 trillion worth of liabilities, at least denominated in U.S. dollars, issued by non-U.S. financial intermediaries who don't have access to the Federal Reserve directly. So that's got its own problems, technical problems, but also problems that the Federal Reserve needs to be concerned about. As for your As for the basics of your question, I think it's pretty clear that you need to care deeply about the structure of your financial markets for how it is that your monetary policy operates. Operationally, it makes a big difference whether or not you have a predominantly bank-based system or a predominantly market-based system in your economy. So because keeping that this is both true for transmission of your policy, how it is changes in interest rates or changes in your balance sheets affect the real economy, where you should be looking, and exactly how you should do it. And it also has to do with how you should utilize the central bank's balance sheet to ensure financial stability through things like lending or market making activities. And I think that if you look around the world, central banks are extremely sensitive to those things, and they do make adjustments as they go along. We've seen a lot of that. I mean, again, a lot of this discussion is about the U.S., but it's true around the world that interventions in the spring of last year, at the beginning of the pandemic, interventions in financial markets by central banks took many forms that differed across jurisdictions depending on the structure of their financial markets. So yes, you have to do that. You have to do that both in normal times and when there's a lot of stress in the system.
Okay, Bill, would you like to comment this as well?
I certainly agree with everything that Steve said. I think the thing that's important, I think, in the U.S. is to recognize that monetary policy really operates through its effects on financial conditions. So the stock market, the bond market, dollar, credit spreads. And so the Federal Reserve is very cognizant, especially under Chair Powell, of how the Fed's monetary policy actions affect financial markets. They don't want financial markets to, overreact to what the Fed does. And they definitely take the financial market response to the Fed into consideration in the conduct of monetary policy. Now, that doesn't mean that the Fed, is trying to push this, it's going to keep the stock market high no matter what. It really depends on what the goals of policy are. But the financial market conditions are an important mechanism that's important in the U.S., to underscore Steve's point, because the U.S. has a largely market-based system. So financial conditions, you get a lot more play in the U.S., I think, than they do elsewhere.
Thank you. We have another question from the audience, which I would like to address to Blaise. So the question is, what should be the emerging markets, central banks, I guess, or countries, standardized toolkit for new policy frameworks of Fed and ECB? So basically, what kind of toolkits us, the central banks, should have? What is the view of the market?
Yeah, I mean that's an excellent question, and I'd be interested to hear your response to that one as well, Ksenia. But I think we've already seen, as I said, a number of central banks move into tightening mode in the last really 6 months or so in all regions. Your central bank, obviously, but we've seen it in Latin America, we've seen it in South Africa, and to a lesser extent in Asia. I think one thing I think we're seeing right now and likely to see is that monetary policy in the emerging markets could become relatively tighter as compared to developed economies. Increasing the real interest rate differential in favor of emerging markets, while potentially inflation expectations deteriorate in advanced economies. That would probably be supportive of emerging market currencies and could produce some flattening of local yield curves around global emerging markets. When the Fed does begin to tighten, when the ECB does begin to tighten, as was said earlier, the historical tendency is that emerging currencies come under pressure. So in the short term, we may see continued currency strength by EM and EMs, and then we could see that reversed. Capital flows, tend to be pretty substantial once the Fed or the ECB start tightening. And so, the risk of capital outflows is substantial. That would probably require further response from emerging market central banks. At the end of the day, I think the fundamental issue here is growth. My main concern about EM in the next, I'd say, 18 months is not so much about a taper tantrum, but rather about the lack of growth outperformance by emerging economies. If you look at the IMF WEO from a couple of months ago, or the update from a couple of months ago, you can see, yes, it's true that, especially when you include China and India, emerging economies will probably outgrow developed economies by a little bit this year and probably also by a little bit last year. But as a career emerging market investor, I can tell you that for most of my time investing in EM, the average growth rate in emerging economies has been multiples higher than in advanced economies. That's just not going to be the case over the next couple of years. And that, I think is going to have a significant impact on policy and on capital flows, or potentially on capital flows. And that's the main risk, both for us as investors and for you as a central banker in an emerging economy. I think Russia has a bit of a unique situation given your large supply of reserves and your quite tight policy mix, generally speaking, even during the crisis. But for most emerging economies, which obviously tried to respond to COVID and tried to respond appropriately, I would say in most cases, that sort of getting back to balance, as it were, is tricky. And I'm glad that they've, in many cases, started moving sooner because that does, I think, increase investor confidence in the policy framework.
Well, thank you, Blaise. Is it only growth what's matter? Or some other fundamentals like debt level, or, as you said, macro policy stance, budget deficit, etc. So this is my first question. And the second question, why growth is low in the developing world? What is your view?
Yeah, no, you're right. Of course, debt levels are important. Debt levels have increased everywhere in the last couple of years. As a share of GDP, that's an inevitability when GDP contracts and obviously large fiscal deficits result. And so, there will be in some countries with higher debt levels, there already is a forced deleveraging. We've seen it, I think, in a country like Turkey over the last couple of years. That's a bit of a unique case, and I'm probably better if we don't go down that rabbit hole. But, I think, we're moving to a period where I think investors could simply chase yield wherever it presented itself, and where differentiation is going to be much more important for investors. And I think countries with sound fundamentals, sound policies, and lower debt levels are going to be more attractive, even if they offer somewhat lower yields. I think that's just, during this kind of transitional period for global policy, I think that's going to be quite important for financial markets. I'd be interested to hear what the others have to say about that.
Anyone would like to comment on this? Don't see a lot of enthusiasm. I would like to ask a slightly different question to both of you about long-term risks about the new framework, or actually the old framework as well. Some people think that asset purchases and kind of low-for-long monetary policy create financial stability risks. And in a sense, we saw it last year, right? Because the low-for-long and massive asset purchases, non-conventional monetary policy will respond to the global financial crisis of 2008-2009. But because of that, the non-banking financial system developed significantly. So last year, the Fed had to intervene even more than 12 years before that in order to support markets. So is this kind of circular problem that every time we try to solve this problem, we end into a bigger problem? So what to do with these financial stability risks? Can policy be just to deal with these financial stability risks? Bill, let me start with you. Maybe then I'll give the floor to Steve.
I think you're exactly right. I mean, we came through the COVID pandemic in pretty good shape from the banking system perspective. A lot of the changes made it post the great financial crisis in terms of capital, liquidity, stress testing, all seemed to work pretty well. But we had lots of problems last spring in money market mutual funds, in the U.S. Treasury market, in the corporate bond market. And I think that just underscores the fact that we haven't really gotten our arms around some of the things that we need to do in the non-bank financial sector. The Dodd-Frank Act that was passed as legislation to reform, financial market regulation post the great financial crisis did a good job on the banking side, but it didn't really do very much on the non-bank side. They set up the Financial Stability Oversight Council to sort of address those kind of non-banking risk. And the reality is the Financial Stability Oversight Council hasn't been very effective in dealing with that. I think we're going to see some changes. I think that money market mutual fund reform is going to happen. This is the third stage of money market mutual fund. So you've already had two reforms. This will be the third one. The Securities Exchange Commission is out for comment with a proposal for reforming money market mutual funds again. I think we'll see a lot of changes to help support the U.S. Treasury market. That was probably the biggest surprise last spring, that the U.S. Treasury market came under such great stress as people tried to turn their treasuries into cash, and the market couldn't satisfy that demand for cash in a very smooth way. So I think we're going to see a standing repo facility from the Federal Reserve that allows people to take their treasuries to the Fed on an ongoing basis. It won't be something that'll be used during peacetime. The rate will be a little high relative to market rates, but it'll be very reassuring because people will know that if repo rates come under upward pressure, they can always go to the Fed and turn their treasuries into cash. And of course, if you know you can turn your treasuries into cash, you don't actually need to do that. So I think that's going to be forthcoming. We'll probably see some other reforms in terms of liquidity requirements for corporate bond mutual funds to make sure that if you're invested in illiquid assets, you don't offer your investors overnight liquidity, because that's a mismatch that's just going to lead to problems. And we saw those problems last March and April.
Mm-hmm. Okay, thank you very much. So as far as I understand, the Fed will have these repo operations, which would be something like a lender of last resort for the NBFI, right? Something like this. Well, thank you very much.
It'll be a lender of last resort, but against a very narrow, type of collateral, probably just Treasury collateral. And because the Fed feels that that's safe. There's no credit risk in Treasury securities. The only risk is market risk, and they can deal with the market risk by having appropriate haircuts. So I think that's probably where we're headed. Broad, standing repo facility that's open broadly to a pretty wide range of market participants, but only against Treasury securities. Okay,
I see that. As far as I understand, there may be other reforms on the Treasury markets, like primary dealers reform. There are talks about that. I don't know, maybe Steve, could you clarify a little bit on this and whether it will have impact on us? I think that's important. Central banks hold lots of treasuries, so I think that everything which relates to this market is important for central banks.
Well, the central banks, I don't think, are the ones that are creating problems when there's market turmoil. They're not out there trying to fire sell their treasuries. But one of the other recommendations which I would strongly support is the shift of Treasury trading to central clearing, which would dramatically reduce. We have some very clear evidence that it would dramatically reduce the needs of dealers to have inventories because of some complicated netting algorithms that could be used. And so I think that's really, those things are really, really important. But I'd like to go back just for, excuse me, for 30 seconds to the beginning of your question, because I think Bill's answer and my answer to this about what's been happening in financial markets really separates monetary policy from financial stability policy almost all of the time. What we're talking about here is a combination of having sufficient buffers and sufficient sort of plumbing that works all of the time. We're not worrying about whether or not interest rates have been low for a long time. Interest rates are aimed at real economic outcomes, at influencing financial conditions generally to try and ensure that central banks meet their inflation, their price stability objectives. That's something I think that we can separate from what goes on in the financial stability realm. Not 100% of the time, but I would say, sort of 99% of the time. So I would encourage people to think about those things as separate policy realms, and to think about the technical and operational issues that are coming up with respect to things like money market mutual funds, bond mutual funds, and Treasury market clearing, derivatives clearing more generally, which still isn't entirely fixed. All of that stuff as a separate issue, but one that central banks can be involved in.
Well, thank you very much, Steve. Let me touch a very different topic in the last 5 minutes, and I would like to ask the next question to Oleg once again. Oleg, I think yesterday the head of the Bank de France, Francois Villeroy, he said that this new Chinese project, digital yuan, digital RMB, is a threat to other reserve currencies like euro or dollar. So it can question the role of these currencies on the global market, and apparently it will lead to significant changes in the global markets, have effect on other emerging markets. So do you believe that this is going to happen? Is this an immediate threat? And if it is an immediate threat, what will be the effect on the global financial markets, particularly on emerging market countries? Please.
Yeah, I would not emphasize any individual development like this, but I think a more secular trend is, the most obvious trend is that China is becoming the second or the first largest country in the world in terms of international trade. It's already became the largest country. And such secular trends, we know over long horizons, they lead to emergence of, other reserve currencies or, the next reserve currency and so on. This is what happened 100 years ago when United States dollar replaced British pound. But that happened after like a pretty long period of dominance of the United States in international trade over the UK and sort of in terms of GDP and so on. And so that's what we can expect over medium to long run, over like we're talking about 20 years here, that China is going to become an increasingly bigger player in the world markets of various sorts. And so as a result, it will affect the global monetary and financial systems in very interesting ways. So this is perhaps the most interesting trends. They just don't operate at high frequencies. It's not something that will happen over a couple of years, over the next 5 years. It's something that will happen over a longer period of time. And in this sense, the change in global monetary system will likely come not from a blunder in U.S. monetary policy or like big financial recession. It will likely just come from the secular forces of growing China. What's most interesting is, the role of the dollar has only increased in the last, 20, 30 years of the ascent of China, right? So, it's been 50 years since the end of the Bretton Woods, but arguably dollar enjoys the largest role currently after, 20, 25 years of really fast Chinese growth, which actually reinforced the role of the dollar over this stretch of time. But going forward, things are likely going to change. We're going to first see it in perhaps the goods market, where we already see now that the dollar is not the unique currency in which goods are traded, right? So there are regional currencies like euro, and so Russian imports and exports are actually more heavily priced in euros than in dollars. And so similar questions would be like in Asia, would there be regional currencies like yuan or yen, or there would be like a bigger shift? But actually the bigger shift that I would expect is the decoupling of Chinese monetary policy from the, pegging to the US dollar. So they no longer peg to the dollar exclusively anymore, but they will have more and more independent monetary policy over time, whether it will come with, digital currencies or conventional currencies. It doesn't matter as much. What matters is they will have more independent monetary policy. And then both for the goods market and for the financial market, this will kind of pose a question, right? Are you kind of keep things stable vis-a-vis the dollar, or you keep things stable vis-a-vis yuan, or some mix of the two currencies? And so these are these big trends that I expect to play out over the next 20 to 30 years.
Thank you very much, Oleg. We have just a few seconds, I would say, but I cannot wait to ask a question to Blaise. Do financial markets actually see this possibility already, or is it still very theoretical that Chinese currency would really be replacing other currencies?
No, I think it's happening in real time. I think if you look at capital flows into China, the Chinese bond market has been open in a significant way, in addition to the equity market in the recent period, and you're seeing strong inflows. Just for us as emerging market investors, there's two different indices. There's the dollar index, the MB, and then there's the local currency index, the GBI. China just joined that latter index a year and a half ago, and it's 10% of that index. In equity indices, it's larger in terms of global emerging market indices. I think the capital is flowing in, and the RMB will be a much more important store of value over time. I think the one thing that I think creates some uncertainty is just around the lack of transparency and the rule of law in China. I think that's something which, of course, the U.S. has offered to dollar investors and dollar holders, the same for the UK in the previous period. And I think that will be a lingering uncertainty for investors, I think, as they look to increase their exposure to China and the RMB over time.
Well, thank you very much, Blaise. So let me try to draw some conclusion from our discussion, because it was very rich and we touched various topics. I think the first conclusion is that our guests today, they're not so much worried about taper tantrum. They believe that the Fed will try to communicate its policy well in advance to escape taper tantrum. But they still think that the Fed may have to react late and fast. And this will, of course, have negative spillovers on emerging markets economies, particularly those with weak growth and weak other fundamentals, I guess. On the one hand, emerging markets have some time, but on the other hand, they have to be prepared to probably higher volatility of Fed's interest rate if inflation pressure particularly will be more not so temporary, but sort of will stay longer and stronger. And there are signs that it may happen. I guess many people start to discuss this. So I guess this is the main issue. The second issue, the second question is a good one, is that the Fed is trying and other regulators are trying to address some weaknesses in the Treasury markets and other sort of core plumbing markets for the global financial economy. So probably financial stability effects will be smaller next time around. And the third lesson is that slowly, but global economy and global financial markets is changing. So we may see really more usage of Chinese currency and more importance of China on the financial markets as well, not only not only in trade and goods market. And the last conclusion which I make for ourselves, the Bank of Russia, for a few years, we had this policy of de-dollarization. Right, we were trying to push financial system and companies to use more domestic currency to decrease risks through that. And it looks like it is a good policy in this new world with more volatilities. It's probably not solves all the problems, but it reduces risks in the long run. So thank you very much to everybody. I think that was tremendously interesting, and actually I learned a lot, including the details about the Fed's policy, which is still we're trying to learn about. And you also, I think what you've said, it helps us to prepare to all kind of uncertainties which can realize in this new post-COVID world. Thank you.
Thank you.
And see you sometimes in St. Petersburg, I hope so.
Thank you.
Thanks a lot.